वेलकम बैक टू आवर चैनल शेयर की तबीयत बुल और बियर। तो फ्रेंड्स, आज हम देखने जा रहे हैं हाउ टू अवॉइड लॉस एंड अर्न कंसिस्टेंटली इन द स्टॉक मार्केट, जो कि लिखित है प्रसेनजीत पॉल ने। तो उनका चैप्टर 2 चैप्टर 2 है, बोल रहा है कि स्टॉक मार्केट इज नॉट रिस्की एट ऑल। सो पहला फेज है उसका इंट्रोडक्शन, चैप्टर 2.1 इंट्रोडक्शन। Many investors prefer keeping their savings in the bank deposit rather than investing in the stock market. The common reason for this is risk. A few days back, I was having a conversation with one of my friends, and he mentioned keeping money in the bank at least assures that it won't lose value, while in the stock market there is no such assurance. Banks offer a steady return on investment. On the contrary, return from the stock market is uncertain. Well, what what if I told you that keeping money in a bank is not as safe as you think? Question mark. Let me introduce a silent killer named inflation. Fixed deposit in banks will surely offer around 6 to 8% annual interest. But have you ever considered this in conjunction with inflation and tax? To put it simply, inflation is the increase in the price you pay for goods. For example, what you will pay for groceries in a year will be more than what you pay for them today. You can also think of it as a decline in the purchasing power of your money. If 2 kg of rice costs rupees 100 today, then after 1 year you won't be able to purchase the same quantity at rupees 100. So today's rupees 100 is not worth the same after 1 year. To summarize, 100 rupees as an investment in bank deposit turns to about 107,108 after 1 year, but it will cost 107,108 rupees to cover the same daily expenses. The situation will worsen if you consider tax. Interest income in a bank's fixed deposit is fully taxable. Dep- Depending upon your taxable income, the tax rate varies. For someone in the highest tax bracket, it can be high at as 33%. Even if you are in the lowest tax bracket, you will need to shell out around 10% tax on the interest income. If you combine tax with inflation, then fixed deposit will yield as a negative return. The irony is that the interest on the bank deposit is indirectly linked with inflation rate. That is, when inflation moves up, deposit rate also moves up and vice versa. Let's do some basic math. Whatever you save from income, you need to pay income tax on it first. Let's assume that your income is 100 rupees and you are in the 10% tax bracket. You would put the remaining 100 10 9 okay 100 minus 10 90 rupees in a fixed deposit for 6 to 8% annual interest. The principal amount is a fixed deposit is not taxable, but interest income is taxable as per tax law. So after the tax on interest, yield will remain anywhere between 4 to 6%. Now we have to figure out what the inflation amount will be. To put in a perspective, 10 lakhs saved in the bank deposit will become approximately 7.5 lakhs after 1 year. Considering 8% interest, 9% inflation, and 33% tax, highest bracket. When you invest in the stock market, you first pay income tax and then invest whatever remains. With an annualized return of 12% plus, you would make enough return to beat inflation and tax. Any investment, bank, post office, deposit that generate less than 9% annualized yield is offering a negative return in conjunction with tax and 6 to 8% inflation. Annualized return of at least 10% plus, that is 12% plus for the highest tax bracket, is required to comfortably beat tax plus inflation. Thus, in conjunction with tax and inflation, bank deposit can't offer a positive return. The worrisome part is that more than 50% of the household saving in India are in the form of bank deposit, while only 3 to 4% of the individual have exposure in the stock market. You may think that investing in a fixed deposit is for diversification. Well, there are many tax efficient debt investment options which offer a steady return and also serve the purpose of diversification. The problem is that many individuals are not aware of this. Further, since personal finance and stock market are not taught in school and college, many people are not even aware of the deadly combination of tax and inflation as stated in the previous paragraph. Personally, I keep only an emergency fund in a bank deposit. The rest of my saving is in equity investing. I don't keep funds in a bank deposit for return or for diversification. It is just for any sudden need of funds for any unexpected event. Chapter 2.2, the one and only risk in the stock market. Investing in stock is like driving a car. In the beginning, no one is an expert in driving. You have to learn how to drive. If you skip the learning and get behind steering wheel on the very first day, what would be the consequence? There is a decent chance that you would get into an accident. Similarly, with no prior knowledge, you are bound to lose money in the stock market. You might earn money occasionally, but that would be from luck. To earn consistently, you must have in depth knowledge in the subject. To avoid an accident, an experienced driver needs to drive carefully. Similarly, seasoned investors should also remain cautious about his investment decision and emotions to avoid loss. Your chance of an accident can be minimized if you follow driving rules. Likewise, by following certain discipline, you can minimize chance of losing money in the stock market. Driving does not require any formal education degree. Similarly, an MBA in finance and CA or a similar degree cannot ensure success in equity investing. Irrespective of educational background and specialization, anyone can learn the tactics of successful investing. It's simple but not easy. Simple in the sense that it does not require high intellectual. Not easy because it requires years long practice, discipline, dedication, and willingness to learn. Avoiding equity investment means you are unlikely to beat inflation. Banks and post office deposit offer negative or flat return inflation and after inflation and tax adjustment. Very few investment options like real estate and equities can offer above inflation returns. Over the last few decades, across the globe and among all the asset classes, equities have outperformed other investment options in the long run. So it is not zero exposure to equities a sheer negligence. Are you not taking a big risk by avoiding equity investment? Avoiding investment in equity is risky, very risky. Chapter 2.3, the only way for wealth creation. Historically, it has been proven that only the stock market and real estate investment can offer an above inflation return in the long run. Real estate inquiries, big ticket investment, thus, this market is not accessible for small investors. For salaried individuals and other professionals, the stock market is the only way for wealth creation. Among real estate and the stock market, the latter should be preferred choice for every individual due to the following reason. 1. You can start investing in equities with an amount as low as rupees 5000. However, in real estate, you can invest with such a tiny amount. For any retail small investor, equity investment is much more convenient. Second, the stock market is highly regulated. Thus, price discovery is much more transparent. Market regulators SEBI has taken several steps to safeguard the interests of small investors. However, in real estate, price discovery itself is not so transparent. 3. Equity investing offers higher liquidity than real estate. You can purchase stock anytime and also sell them moment after buying. There is no obligation. You can sell them after 1 minute, 1 month, 1 year, or 10 years, whatever you want. However, in real estate, you cannot purchase land to sell in the very next day. Chapter 4. You can you can buy and sell stocks from anywhere in the world. With the advent of online trading, physical presence is not necessary. Buying and selling can be done with just a click of a mouse. However, the same cannot be said about investment in real estate. Because of many such advantages and above inflation return, equity must be a part of everyone's portfolio. Avoiding equity investment means your retirement life is at risk. The irony is that retail participation is lowest in the Indian stock market compared to other countries. Widespread misconceptions and lack of knowledge are the major reasons. A few years back, I had a telephone conversation with a first time equity investor. The following is a rough transcript of our conversation. Investor: just a few days back, I came across your website and read the details of your equity advisory services. How much return can I expect by following your strategy? Me: you can expect around 20 to 30% average annualized return over the long term. Investor: only 20 to 30% annualized return? Me: why? It's not 20 to 30% sufficient. Investor: other are offering 30 to 50% monthly return. Me: monthly 30 to 50%? Well, why don't they trade on their own? Frankly, 25% annualized return is sufficient to me. Investor: right now, the market is in uptrend and I went to make the most out of this situation. So I cannot consider you as my preferred choice. Me: well, my advice is to stay away from anyone offering such extraordinary 30 to 50% monthly return. Investor: sorry to bother you. For me, 25% annualized return is too little to consider the stock market. I cannot go with you. Me: fine, not an issue. Just 3 months after this conversation, the same person wrote back to tell me that he lost 2 lakhs rupees from trading by following the entity which promised him 30 to 50% monthly return. I was not at all surprised. Rather, I congratulated him because he finally learned the lesson within 3 months at the cost of 2 lakhs. Now I have a question for you. From the above incident, who you Who would who would you blame for this loss? Many will blame that advisor, and many will blame the stock market itself. Very few may blame that investor, but in reality, it is that investors who is alone responsible for the outcome. Investors are satisfied with 7-8% interest from the bank deposit, but not happy with 20% annualized return from the stock market. During the bull market, you may earn much more than 20 to 30%, but that not permanent and cannot be repeated year after year. Over 15 to 25 years, if your average annualized return remains within 20 to 30%, then you can easily achieve financial freedom. Always remember that the world's most successful billionaire investors and also once the world's second richest person Warren Buffett made his fortune from just 22% annualized return over 50 plus years. On the contrary, many amateur investors desire a 30 to 50% monthly return when they jump into the stock market, end up with a loss and blame the market itself. Sometimes they even mention that equity is another form of gambling and advise others not to invest in stock. So at a glance, investors gladly accept 7-8% annualized return from a bank fixed deposit but cannot accept 20% annualized return from stock market. Chapter 2.4, don't skip the basics. Lack of proper knowledge is one of the primary reasons for widespread misconception about the stock market. Things about it. Completing our formal education requires around 12 years. From nursery to higher secondary level, the journey is quite challenging. In post higher secondary level, we choose our career path. To complete graduation and post graduation, it requires another 4-8 years. After rigorous 18 to 20 years of hard work and dedication, we finally secure a job. Whether you are self employed or a salaried profession, you must go through 18 to 20 years of learning. Every single penny of your earning is the result of those 18-20 years of hard work. But the surprising fact is that in the stock market, investors attempt to earn from day one. Doctors dedicate 5 years in an MBBS course and then few more years in practicing. Finally, they are capable of making money from the profession. However, in the stock market, many investors attempt earning money from the first day. If you are not well equipped with the knowledge and expertise and still going for a critical medical operation, then what will be the consequences? Who, who is the blame for such consequences? Unfortunately, in the stock market, investor jumps with little or no knowledge, end up with a loss and then blame the market, advisor, business media, etc. Excluding themselves, investors are ready to blame anyone. In nutshell, to earn money, a doctor dedicated 5 years in a MBBS course and an engineer dedicated 4 years in a B course. But to earn money in the stock market, many investors are ready to dedicate a single month to learn the basics. Chapter 2.5, investment in knowledge pays the best interest. A stock is nothing but the partial ownership in the business. Consider yourself an owner of multiple local restaurants. As an owner, would you consider buying and selling your restaurant frequently? If your business faces a temporary downturn, would you consider selling a restaurant and then buying it back again when it is a better time for business? Surprisingly, in the stock market, many investors are ready to do the same. A mere 10% rise in stock price tend to book profit, while a 10% drop in the stock price creates panic. The more you trade, the chance of losing money will widen. If you are consider yourself as a partial owner of the business, then you can restrict yourself from frequent trading. Before purchasing car, expensive cell phone or televisions, we could rigorous research. I still remember before purchasing my first car, I had spent a minimum of 30 to 40 hours on the internet over a 3-month span, visiting the showroom thrice and then monitor car price trends continuously for a while. After that, I took a test drive with another friend and consulted my family members and then purchased the car. While purchasing a stock, do you conduct such rigorous research? Consider the last time you made an expensive purchase, be it a car or a mobile phone or a laptop or any other electronic gadget. You try to collect information from reliable sources, internet, etc., and then decide accordingly. But do you spend a fraction of that time doing the research before making an equity investment? Before jumping into the stock market, you need to sharpen your knowledge. This book is dedicated in helping you doing so. From the next chapter onwards, you will learn various aspects of equity investing in an easy to understand language with lots of real life examples. As mentioned earlier, it is simple but not easy. You need to learn more so of what not to do and rather than what to do. To conclude this chapter, I want to mention that you have already taken the first step towards how to avoid loss and earn consistently from the stock market. Keep reading, and I can assure you that equity investing will become much easier, simpler, and rewarding. Benjamin Franklin told that investment in knowledge pays the best interest. ये चैप्टर कंप्लीट हो चुका है, तो उसके कुछ पॉइंट्स, एक हाईलाइट पॉइंट्स है बुक में दिए हुए, वो मैं रीड करने जा रहा हूँ. 1. Equity investing is not risky. Rather, staying away from equity investment is risky. Second, any investment that offers less than 9% annualized return, like the post office, bank deposit, etc., actually yield a negative return in conjunction with tax and 6 to 8% inflation. At least 10% plus annualized return is required to beat tax and inflation. 3. Equity investment is the most convenient option for long-term wealth creation. Fourth, investment in stock is just like driving a car. If you can master the subject, it becomes easier. Fifth, lack of knowledge is the primary reason for widespread misconception and lowest retail participation in the stock market. Sixth, a stock is nothing but a partial ownership in the business. Think of yourself as an owner of the business. Seventh, invest in knowledge before considering equity investment. So, friends, we can complete chapter 2. Now we move in the next video, chapter 3, that will be uploaded today or tomorrow. Thank you. Please subscribe our channel and click on bell icon for any update relating to the books or relating to the share market. Thank you.